a rare market declines posing further economic recovery challenges. Major Chinese banks cut rates again as 2023 ends. China's major banks, including the Industrial and Commercial Bank of China, China Construction Bank, Agricultural Bank of China, and Bank of Communications, along with several joint stock banks, announced their third interest rate cut this year, effective December 22. This move, urged by the government to boost the economy, saw deposit rates drop by 10 to 25 basis points post-cut. Fixed deposit rates range from 1.15% to 2.0%, with a 3-year large deposit rate at 2.35%, Nura economist Lu Ting suggests. This reduction will ease banks' net interest margins, paving the way for the People's Bank of China to lower policy loan rates in January, potentially decreasing benchmark interest rates. Despite these measures, experts, including those cited by Reuters, foresee challenges in stimulating economic growth due to the real estate slump, increasing local government debt, global growth slowdown, and rising geopolitical tensions. As a result, the Chinese government's path to economic recovery appears increasingly complex. Stock market drops. Foreign investment continues to pull out on December 22. China's air major, including Shanghai Composite Index, Shenzhen Component Index, and CHEX Index, saw a downturn in the afternoon, with all three main indices ending in the red. More than 4,000 stocks declined across both markets, with a total trading volume of 7,794 billion yuan, and northbound funds experienced a net sell-off of 2.511 billion yuan prior to December 20th. China's shares hit a low near 2,900 points, making shares a hot topic on Weibo. The market recovered on the 21st after initially dropping below the 2,900 point threshold. The China's Ministry of Commerce reported that from January to November this year, there was a 10% decrease compared to last year in the actual usage of foreign capital, totaling 14.33 billion yuan, approximately 157.5 billion. U.S. analysts, as reported by Reuters, stated that the Central Economic Work Conference last week did not unveil a major economic stimulus plan, which has dampened investor sentiment. A survey by Asia Bank released on Wednesday revealed that more than 60% of Asian fund managers are either in a wait-and-see mode or looking for investment opportunities elsewhere. The survey highlighted a very low interest in risk assets in China. Currently, China is regarded as the riskiest market by international investors. The Wall Street Journal has reported that since August of last year, over 24 billion U.S. in foreign capital have exited the Chinese mainland stock market. Senator Marco Rubio of Florida, a Republican, recently cautioned in a Fox News article that the greatest risk in doing business in China lies in collaborating with the Chinese Communist regime, a move that could ultimately lead to the downfall of Wall Street, Silicon Valley, and major industrial corporations. Rubio advised companies still hoping to prosper in the Chinese market to President Kennedy's inaugural address, warning those who ride the back of the tiger end up inside. China's money supply surpasses 28 trillion yuan this year. Where did the money go? In a post on Platform X on the 21st, a user who identified themselves as a second-generation member of the Chinese Communist Party using the pseudonym Xiangyang claimed that in 2023 China printed a historic amount of currency totaling 28 trillion yuan, approximately $4.2 trillion. This marked the highest currency issuance in a single economy in human history. However, despite this massive increase in currency, there was no significant impact on the stock market, real estate market, or overall prices. This has led to questions about where all this additional money went. To investigate this issue, reporters from Sound of Hope interviewed Chen Sanjing, the director of the New Economic Policy Research Center at Donghua University, on the 22nd. Chen pointed out that the base currency issued by the People's Bank of China has remained relatively stable in recent years. However, financial institutions, including shadow banking activities, have a significant amplification effect when leveraging funds. Chen observed that in recent years, major initiatives such as the Belt and Road Initiative and international expansions have incentivized state-owned enterprises and related entities to invest abroad. This includes investments in Southeast Asian and less developed countries, as well as substantial funds flowing into Western countries. During this process, many individuals seized the opportunity to invest and engage in mergers and acquisitions overseas, resulting in capital outflows from China. This trend was especially prominent among participants in large-scale projects like the Belt and Road Initiative. Chen assessed that currently ordinary Chinese citizens and businesses are hesitant to invest or spend their money due to uncertainties about the future. Consequently, they prefer to save their funds. This phenomenon is evident in the real estate market and the sales of various financial products, including trust products and insurance policies. Despite the excessive currency issuance, some of it is being used by the public and businesses. However, another portion is likely being used to address the debt crisis faced by local government financing platforms. Chin mentioned that the Central Party Committee has instructed the Ministry of Finance to advance the quota for local government debt issuance in 2024, allowing them to raise more debt despite the issuance of an additional 1 trillion yuan in national debt in November. Once allocated to local governments, it might quickly disappear because they may not have sufficient funds to cover their debt obligations. This situation reflects China's strategy of continuously using debt to address various financial gaps. However, whether it's state-owned enterprises, private companies, or individuals seeking opportunities, some money still needs to flow out due to a lack of confidence in the domestic economy. Moreover, considering the current exchange rate of the renminbi, the People's Bank of China is attempting to maintain stability at around 7.2 to 7.3, but the general public remains skeptical. This skepticism is evident in the capital outflows from China. Don't forget to leave a comment in the section below to share your opinions on today's topic with us. Make sure to like and subscribe to see more interesting topics from China.